let's get back to the basics. Now that SoftBank has exploded and their options trade and all the Robinhood traders have gone away, let's get back to the basics of what we talked about in episode 70. For my financial advisors, I know technically you should not have any position take up more than 8% of your asset allocation. I get it. The simplest formula to use, write this down, 2 index funds and 2 technology companies. I think some of you got so excited for the first time to be able to see that you're able to get 100%, 50%, 40%, that you strayed away too far from the fundamentals of investing. I'm going to be very honest with you. Most companies are not producing any profit. So the indexes themselves are a hedge. The technology stocks are the ones that are still moving forward. So you don't need 26. I've seen some portfolios where you guys have 100 stocks in them. I'm like, you've made your own fund. It's not that complicated. Minimize the number of stocks that you have in. So how I came up with what I call the Holy Trinity plus one disciple method. I too used to have a whole bunch of stocks in my portfolio. And guess what would happen? I would have maybe 5 or 6 that were doing incredibly well and 12 that are doing okay or bad, and they're dragging all of my gains down. And guess what? When you go do your fundamental analysis on these companies, it's really hard to do insight and research on 30 companies. So whether you agree with my method or not, I think we all can agree you can't do deep data. You can't do a deep data dive on 35 companies. You can't. It's impossible. It's hard for people that are in the industry to be able to do that. So type in chat, I will keep my positions to a manageable size. If you have dead weight, you have to cut it.
That's a lot. That's a lot to type. Everybody didn't pass English, so they might get tripped up on the word.
Now it's copy and paste time. I see you.
Okay.
Yeah, copy and paste, and then just cheat off your neighbor's homework.
Yo, man, this is the only school you can cheat in, right? We trying to win together. I see you.
We're helping together, right?
Exactly.
Remember, 5-year hold for a minimum. We're talking a lot about generational wealth. Generations are 20 to 30 years. Every day it's like, man, I can't hold for 5 years. But I'm like, you're under Derek Grace's post screaming about you want generational wealth. Post-Trump pack going soon. Right? Shout out to the king.
Shout out to DG.
5 years is a short period of time for investing. And then remember, 30 years is the term that we want to hold for the longest. You want to be able to pass some of these assets on to your kids, grandkids, because how much better would our lives would have been when we all turned 30 if we would have picked up 1,000 or 2,000 shares from friends, family, and relatives, right? So everyone's wondering, okay, after the stock split, even with Apple, what historically has happened? Now let's go through the fundamentals and charts to see what has happened. And then we're going to do a deep dive, and I'm going to give you my formula for fundamentals as well. So this isn't like an Apple rant again this week, but I want to show you. Look at this. Look at this. 1985. Look at this top. So for all my traders, look at these tops that we have. This 2-to-1 split, and look at this drop. Okay, great. And shout out to the class of 2000 again.
Yeah.
We hit a high. And we slid down more than a 50% drop. 2005. What was playing then? It's going down, Young Jock. Right? Right. Live your life, T.I. Great. Another look at how much Apple drops in 2005. Now, for my veterans who have been around for a long time, when Apple had this great run up, we went to 650 and hit 600 plus. Look how far Apple fell after the split. Now, for those of you who have been around, you remember the day CNBC when they were like, hey, they lost it. They don't have any more innovation, no more products. It's the same song and dance that happens. And guess what happened? At the same stock split, hit these highs, and look how far we fell again. This historically happens during stock splits. This is why we always tell you, go do your own research. You don't have to believe in what we say. This site is called macrotrends.net. Go check out the chart for yourself, but you'll be able to see every time Apple has a split, how far we fall. What I want you to do is take the calculation and from a percentage basis, see how far they fall. That will tell you where you should get in. Hypothetically, if Apple keeps the same performance within 4 or 5 years, Apple should be back in the 400s. So that's just a heads up. Now, let's go here. 87, it dropped from 78 to 37.25. 2000, from 51 to 18.56. In 2020, we dropped from 499 to 106. It's going to touch that top again. 400 is an easy target to make. I know past investing does not always lead to guaranteed results, but it does tell you what the probabilities are and what can happen. This also has happened with other companies that have had stock splits. So if you look at the charts, at the technicals, you can understand what the highs will be. And also you can understand where not to buy, because I see a lot of you guys are buying way, way, way too high. Now, even if you don't agree with my philosophy, apparently Colin Cowherd and the great people over at FS1 agrees that Apple is Michael and Microsoft is LeBron. So those are two to put in. So if you don't believe me, you can believe them. And shout out to the good people over there. No shade, but thank you. Right? Europe is very concerned about having to shut down again. So I want to remind you of 5 stocks that had the smallest drawdown during the crash. These stocks went down less than 12%. Please write these down. Costco, because I know y'all tired of me screaming about Apple. Walmart, Eli Lilly. They are a dominator in their space. Clorox, of course, because you need cleaning products, and they were well positioned and capitalized on the opportunity that is there. So we also have to remember, in every crisis, there is immense opportunity. And then Hormel, who also pays a small dividend. So Costco, Walmart, Clorox, and Hormel are 5 companies that barely dropped 12%. So while everything else like cars and cruise lines were falling 50 to 60%, these barely moved in the market to the downside. 3 biotech stocks. So we covered biotech last week, and some of you hit me was like, hey, I need some more ideas and value on what to invest in. So you can look at XBI, which is the ETF. You know how much we love our ETFs and indexes, right? Another one you can write down is RGen. The ticker is RGEN. And the third biotech you can play and look at for the long term will be Amgen.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.